Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. In this video I'm going to cover dollar cost averaging. I'm going to explain what this is and see if this is the best method or if there are other better ways of investing. So what is dollar cost averaging? So the simplest way to put dollar cost averaging is if you're investing a fixed amount of money each month at a fixed time. So say for example you put $1,000 in, you put that money into the market each month at the same time. This will happen regardless of whether the market's high or low. Obviously, if the market's high, you will get less shares, and if the market's low, you will get more shares. The idea is that you might be investing in an index or an ETF that tracks the market, and maybe you've looked and you know that the market will return maybe 8 to 10% over the long run. So you're just trying to average out those payments and get that 8 to 10% return. And this is good because you don't need to really worry about what the market's doing. You're just putting in a fixed amount each month. So in this video today, we're going to look over probably 3 or 4 different examples. We'll do one with dollar cost averaging. We'll also look at placing a lump sum in the market, and a couple of other ways where we kind of also place a lump sum, but we'll kind of be a bit more strategic when we place it. And also, rather than paying a lump sum, we'll also split our investment down into 2 pieces and see how that performs as well. So for the purposes of this video, we're going to pretend that we make a New Year's resolution at the end of last year. We decide that every month we're going to put $1,000 in the market. We've checked online, done a bit of research. We've seen that Vanguard offers an ETF which tracks the S&P 500. So we're going to invest $1,000 in that each month. We know there's a low expense to that. The expense ratio on this particular asset is 0.03%. So that's basically like we're paying kind of $30 for every $10,000 that's invested. I should also say that most brokerages will allow you to buy in fractional shares, but just for the purpose of my example, I'm assuming that we're buying entire shares. So maybe not all the time our $1,000 will buy us an exact amount of shares. So we might end up buying 3 shares, and then we will carry some money over to the next month where we'll use that to again buy shares back. So we will end up, in some months we will get more shares just because of what's been carried over from the last one. So here we can go and look in at the Excel sheet. So we can see the amounts we've paid. Obviously January the price is $298, and then we've purchased 3 shares. And we can kind of go down and look at it, and then it's basically summarized at the bottom and says over the, so we started in January and we've just paid November's, so we've made 11 payments. We spent $10,874.49, and our average cost per share here is $286.17. Okay, so let's take a look at the figures for the dollar cost average example. So here you can see we've made a total investment of $10,874.49, and for that we've managed to purchase 38 shares of the VOO, so that's the ETF tracking the S&P 500 from Vanguard. And we can see that our average cost here is $286.17. So the current share price as we stand now is $328.69. So our value of investment is now up to $12,490.22 based on using dollar cost averaging. So that's an increase of 14.9%. Now this doesn't include the fees, which you might have within your broker, certain transaction fees, and also within this there would be a charge of $32 for the expense ratio, which would be taken out automatically from Vanguard. So we've looked at the first approach, which was the dollar cost average approach. So now we're going to look at a different approach, which is the lump sum approach. So the kind of theory behind the whole lump sum investment is because we put more money into the market earlier, it has time then to grow over a number of years. So this is where you'll hear the phrase time in the market beats timing the market. So basically what that means is if we put our lump sum early into the market, that kind of beats the idea of waiting for a drop in the market the timing there, because in the case of this, we could be waiting years before that actually happens to get in at a lower price. And in those years, maybe the security or the ETF, maybe it's already gone up 200 or 300% in that time that we were actually waiting for a retracement or the price to drop. So that's the idea, that we want to have the most money involved in the market as early as possible. So that's where that idea comes from. So we invest our $11,000 in on January the 2nd. And just a notable point here as well, this is actually at the time that it was bought. We bought it at an all-time high price. So that's one thing you kind of want to guard against a little bit. And I'm going to kind of show the difference that this makes going into the next strategy for this. Once we put that money in the market, we're not going to do anything else with it. We're just going to sit back and we're going to just check it again towards the end of the year, like around now in November, and see how it's getting on. So now let's look at the lump sum example. So we've made a total investment of $10,743.12. And for this, we've got 36 shares. So the average cost here is $298.42 per share. And the current price is $329.69. So the current value of our investment here is $11,832.84. So this represents an increase of 10.1%. So in this case, this has actually worked out slightly worse than the dollar cost average example that we looked at previously. But one thing to bear in mind here is we were buying at all-time highs when we purchased this at the beginning of January this year. We decided we've got a little bit of spare time and we're kind of getting a bit interested in investing. So what we do, instead of putting a lump sum in, we have our $11,000, but we decide we're going to go and look back over what our ETF, the VOO, has done over the previous 5 years. So we kind of go back to 2015 and we just sort of watch the market as it kind of goes up and down. And we notice in that time there's been a few patterns where obviously you will see the market, it will kind of go up and then it will drop down, it will kind of retrace itself. So the general trend is upwards, but you will see on a few occasions, you might see a drop of 10%, which might occur over the space of a week or over the space of a month. But this is we've seen this about 5 times during that sort of almost 6-year period. So we kind of find this a bit interesting. So we think, okay, so maybe like I'm going to see a 10% retracement that's going to happen. So what we decide to do here is we have our $11,000, but we decide we're at an all-time high price in the market. So we're just going to sit there and we're just going to wait for the market to retrace itself when it gets to a high. So it will get to a high, and then we think from our previous experience of looking at the price that it's actually going to drop some point at 10%. So what we see here is, sure enough, we get to February, the whole world goes crazy. We have the pandemic, and the market, within a few days, the market drops more than 10%. So this is the point we decide, okay, this is great. Now we're going to get in here. So here on February the 27th, we get into the stock at $273, and we make a total investment here of $10,935.6, and that gets us 40 whole shares and a little bit of change. So now let's take a look at the lump sum example with some simple logic that we've applied based on looking back in time over some trends, and to see if we can purchase or put our lump sum in when the market is down slightly. So here we can see the total investment is $10,935.6. We've got 40 shares for this. The average cost here is $273.39. and the current price $328.69. So the value of our investment now is $13,147.6, and this represents an increase of 20.2%. So here, just by investing when the market was down by 10%, when we saw the first 10% drop, we've managed to get a significant increase in our return here. But we notice a problem here. So we've invested all of our money now, and we see the market continue to tank. And at one point, it hits the bottom before we kind of see a stimulus package and the price starts to go back up. we've just watched it drop nearly 35%. So now we're going crazy because, oh my God, I've just put in all of my 11,000, and I could have actually split that up, and maybe I could have got in even further down, bought more shares and reduced my cost basis there on the shares. So this would have been great if I'd just been a bit more wise with my money. Maybe I could have split it up and done it that way. So now let's take another look at this example where actually we split it into 2 payments. So what you'll see here is we made our initial investment here at the 273.39. We were trying to be a bit clever and wait for the bottom, but it hit the bottom and then it bounced back up. So we decided to quickly spend the rest of our money, the $5,500, on getting into the shares at 240.24, as we just had some good news that the stimulus package was happening and the share price seemed to be rebounding and heading back up again. So we thought, let's quickly get in our money now because we might miss out on the opportunity. So now let's go on to the last example we looked at, which is kind of a split investment example where rather than putting our whole lump sum in at a certain time, we've decided that we think the market might go down further. So in this case, we decided to split the investment into kind of 50-50. So we've made the first investment $5,500 when the market was down 10%. And then we've made another one when the market had kind of hit the bottom and then got back up, but was still down around 20% from the initial high. So the total investment here is 10,993.32. We've managed now to get 43 shares. So we've managed to get more shares because the cost basis here, we got the shares for a lower price. So obviously here we can actually buy more shares. So you can see the average cost per share is the lowest of all the examples we've shown so far at 255.66. And with the current price 328.69, this means the value of our investment is now 14,133.67. So this is an increase of 28.6%. So that's kind of by far the best return of any of the different strategies that we looked at here. And even a lot more significant than the previous one where we put all of our money in. So it kind of pays to maybe split your investment up into certain, they would call them tranches. So that's like the French word for into smaller pieces or smaller chunks. So that way we've not spent all our money and we can kind of deploy it into the market if it was to go down further. Whereas obviously if we've already kind of spent the whole amount, then we don't have anything to put in if the market drops more. So now let's have a look at the pros and cons of dollar cost averaging. Obviously, the main one is we don't need a lot of money to start off with. We can just start off by investing even probably a few $100s a month, just buy one share of the ETF each month. So that's kind of one of the main benefits. We don't have to have any it's a good passive strategy. We don't have to put any time into thinking about it. We just put in our fixed amount, buy the shares at whatever price they are at the time. So it kind of automates itself. So it means kind of less thinking and less worrying involved on the person who's making the investment. And obviously with that, it takes any emotion out as well. So if we're looking at the disadvantages of dollar cost averaging, the main one here is that we're really limited with our returns, because as the name suggests, dollar cost averaging means that we're literally going to average the market return. So if the market's trending up, then we'll get the average of the trend up. If the market's trending down, we'll get the average of the market trending down. It doesn't really leave any room to make really high returns because you're just taking a piece of the average of the market. And finally, also, it doesn't really protect against risk either. So obviously you can look back and see that the market's trended up over time, but there might be periods where it's gone down significantly or it's trended sideways for a long time, and obviously this is not really protecting against the risk for that. So does dollar cost averaging work? I think it does work, but I believe there's a lot better ways out there that don't involve much thought either. You don't have to take a completely active approach. You can still get great results the same. And also, if you're going to use a dollar cost averaging strategy, I would suggest probably using it with something that's like either an index fund or an ETF that's tracking an index, because at least then you're getting the general return of the index or the market, so like the S&P 500 or the Dow, just so that at least that way that's diversified to a certain extent. If you're just blindly putting your money into one stock a month, I mean, that might be a great stock now, but if you don't know anything about it, then you could end up getting burnt on that as well. Now, I know I've taken quite an interesting example of 2020, which is definitely not a typical year. And also what you need to realize is when you're looking, if you're doing back testing, if you look back at data, obviously in hindsight, it's a lot easier to look and say, oh, there was a 10% drop. When you're in the actual moment looking at it, you don't feel the same way about it. You don't know exactly what's going to happen. It could drop another 3-4%, or it actually could go back up, or it could tank, and you will see it. You will see the market kind of jumping up and down during this as well. So I hope that I've also demonstrated that just with a little bit of kind of forethought and small amount of knowledge, I'm not talking like anyone going away and studying like loads of indicators and then obviously spending weeks researching indicators, looking for trigger signals, entry and exit signals when you can get in and out of the market. I mean, if you're interested in that, you can do that and you probably might end up with better returns, but obviously that's quite a time-consuming process. So I hope that I've showed in this video that just with a little bit of kind of logical thinking that we can actually be a bit smarter with how we do this. So I think there are definitely better ways of working this than dollar cost averaging, which don't necessarily involve a huge amount of thought either. So I just wanted to kind of show a few examples of that. Obviously, as well, as you can see for the example, we could have got a much better return actually if we'd split, even if we'd split our 11,000 into 3 sections. We could have bought like on the way down as it kept getting lower. So that's one thing to also look at when you're looking at kind of the financial aspect of the money allocation, because that's actually also critical. Because if you spent all your funds when the money's gone and it's getting lower and you actually want to buy more because the price is actually more attractive now, then you're kind of stuck there. So it's always worth considering your money strategy and how you're allocating it as well. So that's it for the video. If you have any comments about anything that I've discussed in the video or opinions, I'm always happy to hear those as well. If you haven't already and you enjoy the content, please consider subscribing and also hit the bell icon for notifications of when I release new videos. So that's it for this week. Thanks guys, I'll see you in the next one. Cheers.